Welcome to the video summary series for Pedisco's financial accounting textbook. In addition to chapter summary videos such as this one, financial accounting also offers podcasts, virtual tutor e-learning, homework activities with anti-cheat and auto-grade functionality, and detailed instructor resources. Find out more at pedisco.com/finac. For now, over to the author.
Hi again, I'm Rachel White and welcome to the next summary in the Pedisco accounting series. In this one, we're going to cover how we adjust the accounts at the end of the accounting period, starting with some timing and reporting issues, and then moving on to how we record the four main types of adjusting entries: prepaid expenses, unearned revenues, accrued expenses, and accrued revenues. Let's start by exploring some timing and reporting issues. Imagine you are the owner of your own fortune-telling business. Now, while you know that your business is doing well and will continue to do so in the foreseeable future, the people who loaned you the money to start up the business aren't quite so convinced. And they're a bit impatient too. They cannot wait till the end of the business to know how successful you are in earning revenues by predicting the future. They want to know now. They've requested you provide them with financial statements each month that inform them how the business is going. In order to do this, you need to separate all of your business activities into what is known as accounting periods, which is the period of time over which accounting information is collected, summarised and reported to users. The concept of an accounting period leads us to the first of the four main principles introduced in this section, the time period principle. This principle assumes that the economic life of the business can be divided into specific time periods, such as a month or a year. It is the time period principle that underlies the concept of the accounting period. The second principle is that of accrual accounting, which is best explained by an example comparing cash and accrual accounting. It's the last week of the month and you have just earned your biggest revenue for a corporate client by predicting they should go ahead with their plan to build a new office building. But being a corporation, they're not going to pay you until next month. The question is, do you record the revenue earned when you provide the service or when you receive the cash for the service? Under accrual accounting, you recognise the revenue at the time it is earned, regardless of when the cash is received or paid, while under cash accounting, revenues and expenses are only recognised when the related cash is received or paid. So, which one do we use? Accrual accounting, because it is the one required by GAAP. It is also the reason we need to record adjusting entries, because under cash accounting, there are no adjustments to be made. Now, accrual accounting is related to the third accounting principle, the revenue recognition principle, which states that revenues are recognised when they are earned. The fourth principle is the matching principle, that expenses should be recognised in the same accounting period as those revenues earned from those expenses. Now that we've discussed timing and reporting issues, we're ready to talk about recording adjusting entries. The reason we record adjusting entries is to update the accounts to reflect the revenues earned and expenses incurred during the accounting period. Each adjusting entry will affect at least one income statement account, either a revenue or an expense account, and at least one balance sheet account, which will be either an asset or a liability account. Remember, the cash account is never used in adjusting entries. There are four different types of adjusting entries which we can see in our Pedisco textbook. Two of the adjustments are classified as prepayments, which is where cash is received or paid in the accounting period before the revenue or expense is recognised. Prepayments include prepaid expenses or unearned revenues. The other two adjustments are accruals, which occur when cash is received or paid in the accounting period after the revenue or expense is recognised. Accrued expenses and accrued revenues are the two types of accruals. Both prepayments and accruals are recorded at the end of the accounting period after the unadjusted trial balance has been prepared, but before preparing the financial statements. So now that we know the four different types of adjusting entries, the next step is to actually record them in the accounts, starting with prepayments. Prepayments, or prepaid expenses, are assets that expire as time passes or through use. As they are consumed, their cost needs to be transferred from the asset account to an expense account. For example, remember the $300 gym membership we purchased in the second summary video? Well, if we go back to the beginning when the membership was purchased, we had 3 months left to pump iron, which is recorded as a debit to the prepaid exercise account and a credit to cash. but at the end of the first month, we had used up 1 month or $100 of the gym membership. The adjusting entry to record the expiry of the membership consists of a debit to an expense account, say exercise expense for $100, and a credit to the prepaid exercise account for $100. Note that the date of the adjusting entry is recorded as the last day of the month, which in this case is the 30th of November. Apart from prepaid expenses, the other type of prepayment is unearned revenues, where cash is received before the revenues are earned. So let's think back to our fortune-telling business. Our major corporate client loved our work so much that they have paid us in advance to provide our fortune-telling services on a weekly basis. They have paid us $10,000 for 10 one-hour consultations for the next 10 weeks. This was recorded as a debit to cash and a credit to unearned revenues for $10,000. At the end of the month, we have provided 2 of those 10 sessions, so need to record the $2,000 revenue we have earned. The adjusting entry consists of a debit to the liability account, unearned revenues, to recognise we no longer owe the client the 2 hours of consultations. The credit is recorded in the revenues account to record the revenues earned. So, at the end of the month, we have an additional $10,000 in the cash account and have earned $2,000 recorded in the revenues account and a liability to perform the remaining $8,000 worth of consultation hours, which is recorded in the unearned revenues account. Now that we have discussed the 2 prepayments, prepaid expenses and unearned revenues, we're ready to cover the accruals, starting with accrued expenses. Accrued expenses are expenses that we have incurred, not recorded in the accounts and not paid for. For example, as part of the fortune-telling business, we incurred $150 worth of telephone expenses for the month. The adjusting entry to accrue this expense in the accounts consists of a debit to the telephone expense account for $150 and a credit to the telephone expense payable account for $150 to recognise that we will pay the telephone bill in a future accounting period when the bill is due. After accrued expenses, the final type of adjusting entry is accrued revenues. Accrued revenues are revenues that we have earned that are not recorded in the accounts at the end of the accounting period and for which we are due to receive the cash in a future accounting period. The journal entry for accrued revenues consists of a debit to accounts receivable for the amount of the accrued revenues to record the cash that is expected to be received from the revenues earned. The credit is recorded in the revenues account to record the revenues earned, so the correct amount of net income can be reported at the end of the accounting period. We have just gone through one example of each type of adjusting entry, but there are many different possible examples of adjusting entries that could be recorded in the accounts. Your Pedisco e-workbook can help you master adjusting entries by allowing unlimited practice of questions on adjusting entries. In this example, a florist pays $70,128 rent in advance for the next 2 years. This prepaid expense was originally recognised as an asset. After 1 month, the adjusting entry to record that 1 month's rent has expired is recorded by selecting a debit to rent expense for $2,922 and a credit to prepaid rent for the same amount. We can submit that, and now we get personalised feedback for our answers and an explanation for the question. So that's Chapter 3, Adjusting the Accounts. The key topics were timing and reporting, recording adjusting entries, prepaid expenses, unearned revenues, accrued expenses, and accrued revenues.